This is a trader who believes he understands the market. He has spent countless hours studying charts, watching videos, and learning strategies. He knows the terminology, recognizes patterns, and feels prepared. On the surface, everything suggests that he should succeed, but in just a few minutes, something goes wrong. A trade that looked perfect begins to fall apart. The price moves against him, and before he can fully process what is happening, he is already losing money. The most frustrating part is not the loss itself, but the confusion that follows. He doesn't understand why it happened. Let's go back to the beginning of that moment. It's early in the day. The market has just opened, and he sits down with focus and confidence. He opens his laptop and studies the charts. Everything looks clean. The trend is clear, the indicators are aligned, and the setup appears almost too good to ignore. It feels obvious, the kind of opportunity that traders wait for. So he enters the trade. At first, everything goes exactly as expected. The price moves in his favor, and he sees a small profit appear on his screen. There's a sense of relief, even excitement. It feels like validation, like all the effort he put into learning is finally paying off. But then the market shifts. The price starts to move down. At first, it's small enough to ignore. He tells himself it's just a normal pullback. That's what he has learned, after all. Markets don't move in straight lines. This is part of the process. But the price doesn't stop. It drops a little more, and now he starts to hesitate. The confidence he felt just moments ago begins to fade. A question forms in his mind. Should he exit now or wait for it to recover? He decides to wait. As the seconds pass, the loss grows. Slowly at first, then more quickly. What was once a small dip is now something harder to ignore. His attention narrows. His focus shifts completely to the screen. Every movement of the price feels significant. Now the emotions begin to take over. There's tension in his body. His thoughts become less clear. Instead of following a plan, he starts reacting to what he sees in real time. The market is no longer just data, it feels personal. He watches as red candles continue to form, one after another. The pressure builds, his breathing changes, his heart rate increases. It becomes harder to think logically. At this point, the strategy doesn't matter anymore. Finally, he exits the trade. He takes the loss. There's a moment of silence, a mix of frustration and disappointment. And then something unexpected happens. The market reverses. The price begins to rise again. It moves in the exact direction he originally predicted. Now the confusion turns into something deeper. What went wrong? The analysis seemed correct. The setup was valid. Even the timing wasn't completely off, and yet the result was still a loss. This is the moment most traders misunderstand, because the problem wasn't the market, it was the way he responded to it. Trading is often described as a technical skill. People focus on charts, indicators, and strategies, but what truly determines the outcome is something far less visible. It's the ability to remain steady when things don't go as expected. It's the ability to follow a plan even when emotions are pulling in the opposite direction. It's the ability to accept uncertainty without trying to control it. Most traders never develop this. Instead, they react. And this pattern repeats itself in different forms. Imagine another situation. A stock suddenly starts moving rapidly upward. Large green candles appear one after another. The momentum is strong and there is a sense of urgency in the market. Everyone seems to be buying. He wasn't planning to trade at that moment. There was no setup, no clear signal. But the movement is hard to ignore. He feels a different kind of pressure now, the fear of missing out. It's subtle at first, but it grows quickly. The longer he watches, the stronger it becomes. There's a voice in his mind telling him that this is an opportunity he shouldn't let go. So he enters the trade, but he enters late. Almost immediately, the momentum slows down. The price hesitates, then begins to fall. What looked like strength just moments ago disappears. Now frustration sets in. He tells himself he'll recover the loss. He enters another trade, then another. Each decision becomes more impulsive than the last. The focus shifts from following a strategy to trying to win back what was lost. At this point, it's no longer trading, it's emotional reaction, and the market does not reward that. The losses begin to stack up, not because the market is unpredictable, but because the decisions are no longer grounded in logic. There was a plan at the beginning. There were rules, including a stop loss designed to limit risk, but in the moment, those rules feel restrictive. He adjusts them, moves the stop loss further, gives the trade more room, just a little more, but the price keeps moving against him. What started as a small, controlled risk becomes something much larger. One small decision leads to another, and the situation escalates. This is how most losses actually happen. Not from a lack of knowledge, but from a breakdown in discipline. The market itself is neutral. It doesn't target anyone. It doesn't respond to emotions. It simply moves. But every movement tests something within the trader: fear, greed, patience, ego. These are the real variables. And most traders fail not because they don't understand the market, but because they don't understand themselves. Profitable traders are not perfect. They don't win every trade. They don't predict the market with complete accuracy. What makes them different is how they respond. They accept losses as part of the process. They don't take them personally. They don't chase opportunities out of fear. They wait for the right conditions. They follow their rules even when it feels uncomfortable. They don't try to control the market. They focus on controlling their actions. This creates consistency, and consistency is what leads to long-term results. But there is one more layer that most people never talk about. It's not just about controlling emotions in the moment. It's about preparing your mind before the trade even begins. The way you think before entering a position determines how you will react when things start to change. If you enter a trade expecting to win, you become fragile. Any movement against you feels like a threat. But if you enter knowing that loss is a possibility, you remain stable. You stay objective. This shift in mindset is subtle but powerful. It allows you to see the market clearly without distortion. It allows you to follow your plan without hesitation. And over time, it separates those who survive from those who don't. So the next time you take a trade, shift your attention. Don't just watch the charts. Don't just analyze the price. Pay attention to your thoughts. Notice how you react when the market moves against you. Notice the urge to act without a clear reason. Notice the moments where emotion begins to override logic, because that is where the real battle takes place. And the moment you learn to manage that, everything begins to change. That is the point where trading stops being a struggle and starts becoming a process. And that is the point where you stop behaving like most traders and start thinking like the few who actually succeed.